Analysts are hoping that the anticipated interest rate decision today will signal the peak of the Reserve Bank's hiking cycle. In the last meeting, the central bank raised interest rates by 50 basis points. Now, this week, two central banks on the continent of Africa, that's Ghana and Nigeria, they've announced their rates decisions. To speak to us more now on these economies and whether or not the African continent is on par with its rates trajectory, we speak now to Research Associate at Wits University, Gideon Chitanga. Mr. Chitanga, thank you very much for your time. Let me paint this quick context for you. Nigeria raising interest rates for an unprecedented seventh consecutive time, signaling what some are saying is a hike that might go up even further. Ghana also maintaining interest rates, though, this week at 29.5%. South Africa is nowhere near the levels of where Nigeria and Ghana are, yet consumers are already feeling the pinch. We're simply not coping. Can it get any worse, this interest rates environment?
I think at the stage that we are at, for Ghana, there is some significant improvement in the economic conditions. For South Africa, there are projections that inflation might slow down, I think, over the coming months. For Nigeria, the situation looks a bit uncertain because post the election, the expected key economic indicators which should have emanated from a sense of new policy approach have not been there. But there are a few layers that we should talk about here, and I think that there are two or three dimensions of it. This trend of inflation targeting was, I think, triggered not only in the three countries that you mentioned, but internationally by the external shocks of the conflict in Ukraine and the sudden rise in food inflation and fuel inflation, yet a significant effect across the globe. African countries were obviously affected more severely because many of the economies, including the three that we are discussing, are quite fragile. The second thing that we have to think about is obviously the effect of the regulation and management of the US dollar by the US Fed. And this is done outside the concerned countries that you have mentioned as part of the US economic management, but also global economic management. I think the key thing to take is the historical economic architecture, the dominance of the US dollar. It continues to be a major factor in the failing economies. Hence, countries like the BRICS, the community of countries, African countries, China and others, are already mooting an idea of structuring trade around indigenous economies, indigenous currencies, or alternatively coming up with a new currency outside the US dollar, which would be based on gold and run and regulated by the member country economies.
Yeah.
The last part is the domestic conditions of the three countries, but also the African countries that we have mentioned. I think that is, for South Africa, significantly, we are seeing two characteristics of this aspect. One is, for the first time in South African history, we are seeing South Africa's foreign policy significantly becoming a factor into its economic prospects. And you might have seen last week that the rand got a serious knock after issues were raised about whether South Africa supplied arms to Russia. And for Ghana and Nigeria, I think these two countries have serious domestic political issues that are affecting the economic stability. So inflation will continue to be unpredictable because of a combination of these factors. Currently, the external shocks are have a major effect than the domestic factors. But where the domestic factors are aggravated, like in Nigeria, I don't see an end to it. The Naira has lost its value, and there are no clear prospects as to how the government of Nigeria will try to manage the domestic currency and improve the conditions of its citizens.
Yeah. I'm going to move away from the state of the economic health of these economies because I think you've dealt with that. Final question to you. Are there similarities or perhaps clear differences in how central banks on the continent of Africa are opting to deal with rising inflation?
In the three countries that you have mentioned, the approach is quite uniform. It's inflation targeting. Let's continue to raise interest rates and see whether we can control inflation. Unfortunately, I think the key issue is whether this inflation targeting is directed at the key drivers of the causes that are inflaming inflation. And if you look at the two countries, the mix of the domestic and international pressures, the mix of the domestic and external pressures, they vary. So the question would be, is this one uniform measure enough to address rising inflation? And in some cases, the instability of domestic currencies, which continues to fuel high cost of living and erode salaries and domestic incomes. I think the problem with this way of managing the economy is that it hits deep in the pockets of consumers, whether it's at the level of expenses towards food and fuel or expenses towards property, because you are simply trying to arrest the amount of money that is circulating within the economy. Yeah. And unfortunately, the immediate impact is very heavy on the citizens. The assumption is always that in the medium to long term, you stabilize the economy and with some form of recovery, there may be benefits for citizens. In the past 6 months and in the past year since the conflict in Ukraine, we have not seen this receding. We are seeing this situation worsening and living conditions worsening, salaries getting eroded, and I'm not sure this intervention is serving the purpose in the short term.
Gideon Chitanga, let me thank you very much for your time there, research associate at the University of Witwatersrand. Very, very important conversations there at a time where there are warnings of possible unrest as a direct result of the cost of living that is simply unmanageable.